Credit sales. Now, this is something which one should understand because this is something which you are more likely to come across than maybe some of the earlier exemptions that we saw. Let's look at a case where a company, ESCO, makes a sale on credit to another company in the state of residence. I mean, this is a misnomer. We can choose to use this or anything else. And under the terms of credit sale, until the payment is made, let's say X is supposed to pay interest to the company ESCO. The question is, will such interest be liable to tax under Article 11, or is there a likelihood of getting some exemption? Effectively, if you see, the payment of interest in such a case by X LLC to ESCO is nothing but on account of delayed payment. And there is very much a possibility that the interest that it pays might actually be similar to the interest that this company pays to some external bank or otherwise from whom they have obtained funding. In other words, they may get the interest and they may further pay the interest. Due to this reason, the Model Convention provides that the country can agree that where the interest is paid in respect of an indebtedness arising as a consequence of sale on credit of either equipment, merchandise, or services, then such interest paid will be exempt from the applicability of TDS, or tax deducted at source, or withholding tax as you may call it. And the reason is simple. This interest is nothing but actually a compensation which has been given to this company for the delayed payment, because of which it might already be paying some more interest. Now, in the model commentary, it's mentioned that it doesn't matter whether this interest is actually embedded in the selling price itself or it is mentioned separately. In both the cases, the states can agree that the interest which has been paid for such a delayed payment will not be liable to withholding tax under the provisions of Article